Hello, ladies and gentlemen. I am the Acca tutor, your number one and very best Acca tutor online. Okay, I'm Jeremy Tukulu and I welcome you all to this Acca AA Week 3 Fraud, Error and Laws and Regulation lecture. Okay, in this video we are going to deal with everything related to fraud, error and laws and regulation in line with the Acca Audit and Assurance syllabus for those who are writing for June and September and December 2022. Please, you are just covered. Okay, you are covered in this video lecture. Okay, so I just want you to fasten your belt and relax because you are going to enjoy the hunt. Okay, so without wasting much of your time, please let us just go straight to business. All right, fraud is everywhere. Fraud and in every academic press, on the TV, everywhere on the news there is fraud. Somebody would have been nabbed with fraud. Okay, so what shall we do as auditors? All right, this lecture is designed to equip the auditors with the necessary knowledge and skills in dealing with fraud or in investigating or in attending to fraud issues. However, you would also remember that the main focus of the auditor is on the financial statements, right? On the financial statements as a whole, right? He's not actually inclined to investigate a particular case of fraud, but he would perform his audit to ensure that whatever fraud that is there should be detected. However, if fraud is well concealed, is well covered, is well connected, it's very difficult because employees collide, employees do anything to ensure that auditors will not see anything. So this lecture is actually an eye-opener to those who are going to face fraud or to be questioned about it within an exam. Alright, so let us get started, ladies and gentlemen. Alright, remember there is what is called fraud, there's also something called error. Alright, fraud, they say fraud is actually intentional. Okay, fraud is intentional, but this guy is unintentional. Unintentional. Alright, it might happen, but it wasn't my fault. Alright, so I do not want auditors to be this guy who actually needs a microscope, to work with a microscope to ensure that he detects a fraud. Of course, we want such crazy, dedicated auditors. We need them, but you see, as you get deeper into this discipline, that you don't need to be a wizard to detect fraud. That's not actually part of your responsibility, but you need also to perform your audit in such a manner that whatever material fraud exists in the company should be detected. Alright, so we'll see as we go. Now, what is fraud? Fraud is the deliberate falsifying of records or misappropriation of company assets. Fraud can be fraudulent financial reporting, for example, overstating profits to attract investors and lenders, or misappropriation of assets, for example, the theft of cash, inventory, or non-current assets. Error is the innocent misstatement of amount or loss of assets. Then there is this term, teaming and larding. This is a fraud on trade receivables, the theft of money from customer A is covered up by allocating later receipts from customer B to customer H's account. So we are robbing Peter to pay Paul. That's teaming and larding, and this is actually a very interesting and common exam term. Usually in most examinations of the Acca AA paper, teaming and laundering is often asked or is actually found somewhere. So you just have to know that when you are doing teaming and laundering, you're just using somebody's money to actually fill the gap on where we have stolen something. Alright. Now, whose responsibility is it for fraud prevention and detection? There is always a knowledge gap that people feel that when auditors come, they should detect fraud. They think that's their main purpose. But you must also remember that auditors are guided by international standards on auditing. Those standards, they do not put this responsibility on auditors, but that's the responsibility of the managers of the entity. The entity's management is actually responsible for the prevention and detection of fraud. However, the auditor should perform his audit to ensure that whatever material fraud exists, that should be detected and reported upon. Okay, so at the planning stage, the susceptibility of an entity to fraud should be discussed with management, with the engagement team members. Fraud must be communicated to those charged with governing if it results in material misstatements or if management is implicated. It is important, even for what appears to be a small fraud, to investigate how long it has been going on for, how much is involved, and who is behind that fraud. The external auditor's responsibility. The external auditor is responsible for obtaining reasonable assurance that the financial statements taken as a whole are free from material misstatement, whether caused by fraud or error. So, like I said, the focus is on financial statements. That's the focus of the auditor. He's not going to focus on a particular corner or a particular point within his audit, but he is focusing on the financial statements as a whole. Right. Therefore, the external auditor has some responsibility for considering the risk of material misstatement due to fraud. In order to achieve this, the auditor must maintain an attitude of professional skepticism. Alright, this means that the auditor must recognize the responsibility that a material misstatement due to fraud or error could occur regardless of the auditor's prior experience of the client's integrity and honor. Sometimes when you came for this client last year, they were behaving good, they were good people, they were actually Catholic or let me just say Christian or whatever religion they were actually dedicated to this particular religion. They were behaving very well, they were so nice. However, they have been tempted, they have been overtaken by the cunning of this world. Okay, so they are now treacherous, they are now greedy, they have adopted a new culture, a new behavior. So do not believe them because you trusted them last year. Don't just accept everything at face value. You just have to be professionally skeptical. Okay, being alert to whatever evidence that might come by that might suggest that something could be wrong. Okay, you also need to consider any incentives to commit fraud, for example, profit-related bonuses or aggregates. For example, during the year, the board has decided to reward their managers based on profitability of the company. That could be an enticement to commit financial fraudulent financial reporting. Alright, then discuss among the engagement team the client's susceptibility to fraud. ISA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment, requires that you need to discuss among your team members the susceptibility to fraud of the client. Okay, sometimes there might be some areas, some gray areas which need to be polished up. There could be some areas where there could be some loopholes for fraudsters to pounce on the entity. Okay, you need to identify and assess the risk of material misstatement due to fraud. You need to identify through inquiry how management assesses and responds to the risk of fraud. You need to inquire of management internal auditors and those charged with governance if they are aware of any actual or suspected fraudulent activity. Lastly, obtain sufficient appropriate evidence regarding the assessed risk of material misstatement due to fraud by designing and performing audit procedures that respond to the assessed risks. Responses to assessed risks of fraud. Obtain written representation from management that they have informed the auditor of all known or suspected fraud. Okay? Test year-end journals and adjustments as these may be used to manipulate the figures in the financial statements. Test accounting estimates and areas of management judgment for reasonableness. For example, you may be told that the fair value of our let's say investment property has increased substantially. Okay, you need to know what inputs were they using in coming to those values. You need to test them for their reasonableness. Okay, make audit procedures unpredictable so that client cannot hide fraud in areas the auditors is not expected to test. You mustn't be known that you are always going to use this part during your audit. Sometimes you just have to be unpredictable. Yesterday you were actually, in the previous audit you were actually concerned about particular inventories, but this time you may change direction and ask for others. You may have been interested in working with internal auditors' evidence, but this time you might actually work closer to security guards. That's just have to be unpredictable. Use suitable experienced staff to audit areas of particular risk. You need to have good staff, good auditors with you as part of your team. Not only owing to the inherent limitation of an audit, there is an unavoidable risk that some material misstatement may not be detected even when the audit is planned and performed in accordance with ISIS. Excuse me. The risks in respect of fraud are higher than those for error because fraud may involve sophisticated and carefully organized schemes designed to conceal error. That's a fact. Now, misstatements identified. All should be communicated to management. Whatever misstatement you have seen, please make sure it has been communicated to management. Management asks to correct them or explain why not. Often the audit committee will be involved in these discussions. Assess materiality of uncorrected misstatements. Obtain written representation from management that they believe uncorrected misstatements are not material. If management refuses to correct a misstatement which the auditor thinks is material, then the auditor will have to issue either a qualified or adverse opinion. Note it is management's responsibility to correct errors in the financial statement. Auditors cannot unilaterally adjust the financial statement that have been prepared by management. We do not want to see crazy auditors out there into the market who behave in a crazy way, where you see that managers are saying that the figure they believe to be is $800,000. Then the auditor unanimously adjust that figure to come to 300. That is wrong. Okay, you have to ask managers to correct or to adjust whatever figure you want them to adjust. If they refuse, do not correct those financial statements for them. Okay, but you just have to think about what is the implications of the uncorrected misstatement on your audit, on your report. Okay, do not adjust anything for managers. That's the duty for the accountants of the company you are auditing. It is not your duty. Alright? Now, reporting of fraud. If the audit identifies a fraud, they must communicate the matter on a timely basis to the appropriate level of management, those with the primary responsibility for prevention and detection of fraud. If the suspected fraud involves management, the auditor must communicate the matter to those charged with governance. If the auditor has doubt about the integrity of those charged with governance, they should seek legal advice regarding the appropriate course of action. Remember, there is a difference between those charged with governance and management. They are different, these people. Usually, those charged with governance are the board itself, the board of directors. Of course, in this board of directors, managers might also be there. Okay, but when you're talking of management, we are simply talking of the executives and other senior managers. But when you're talking of those charged with governance, we are talking of board of directors, okay, or the institutional investors, institutional investors. Usually, these ones they those with a controlling stake. All right, they might be to some extent, these guys could be very influential. All right, there is also the committees of the board, like the audit committee. Audit committee is also part of those charged with governance. All right, the audit committee, the board of directors, and so forth. All right. In addition to these responsibilities, the auditor must also consider whether they have a responsibility to report the occurrence of a suspicion to a party outside the entity. While the auditor does have an ethical duty to maintain confidentiality, it is likely that any legal responsibility will take precedence. In this circumstance, it is advisable to seek legal advice. So, in most cases, when the auditor is involved in some conflicting situations or some friction with the client, there is need to look for some legal advice, especially when there is need to report something in terms of the law which might actually impinge or conflict with the confidentiality principle. There is need for seeking legal advice. Okay, so there is need to seek legal advice. Then, if the fraud has a material impact on the financial statement, the audit report will be modified. When the audit report is modified, the auditor will explain why the audit report is modified, and this will make the shareholders aware of the fraud. So in the exam, you may be asked, okay, how do you report fraud in an audit? Okay, how do you report fraud? The fraud is reported through the modification of a report, through the modification of the audit report. That's how the auditor reports that to the shareholders. You report that through your audit report, okay, by modifying the opinion, okay. When the audit report's opinion is modified, then we know that the shareholders will know that something could be wrong, and the basis for the modification paragraph is also going to explain why the modification was made, and the fraud obviously would be exposed. Alright, responsibilities of internal auditors in respect of fraud. Remember, there are also people called internal auditors. Alright, the auditor we have been referring to so far was the external auditor. External auditor, usually those Deloitte and Touche, PwC, Grant Thornton, and others. All right, they are the guys who come from outside the entity to come and audit. All right, and those ones are the main characters in this particular course, the audit and assuring. We are actually talking of those external auditors. All right, but there are also these guys called internal. The internal ones, these ones, they are employees of the entity. Okay, they work within the entity, but they have their particular section called internal audit. All right, so they also have got some responsibilities with respect to fraud. Typical functions the internal auditor can perform in relation to the fraud and error, are to test the effectiveness of the internal controls at preventing and detecting fraud and error and provide recommendations for improvement to control. Perform fraud investigations to identify how the fraud was committed, the extent of the fraud, provide recommendations on how to prevent the fraud from happening again. Then, perform surprise asset counts to identify misappropriation. The presence of an internal audit department may act as a deterrent to fraud in itself, as there is a greater chance of being discovered, because these guys, they work within the company, they usually know how those loopholes are vulnerable and how they can actually counter the vulnerability of those loopholes. So it is actually very easy for the internal auditor to identify the fraud than for the external auditor. Alright. So it's a bit easier. Alright, let's now talk of law and regulations. Excuse me. The auditing standard that is relevant to this particular article is International Standard on Auditing 250 provides considerations of laws and regulations in an audit of financial statement, and the objective of the audit according to paragraph 11 is to obtain sufficient appropriate evidence regarding compliance with the provisions of those laws and regulations generally recognized to have a direct effect on the determination of material amounts and disclosures in the financial statement, to perform specified audit procedures to help identify instances of non-compliance with other laws and regulations that may have a material effect on the financial statement, to respond appropriately to identified or suspected non-compliance laws and regulations identified during the audit. The standard defines an act of non-compliance as follows: acts of omissions or commission, intentional or unintentional, committed by the entity or by those charged with governance, by management, or by other individuals working for or under the direction of the entity, which are contrary to the prevailing laws or regulations. Non-compliance does not include personal misconduct and related to the business activities of the entity. So, when you're talking of non-compliance, we are simply talking about compliance issues or activities which have been committed by the employees or the managers of the company during the course of their work, okay, when they were conducting business activities, they end up breaking the law. So that's what we are talking about. We are not talking about things which occurred at a beer bench on a Saturday night when the director was actually off duty, and the auditor shouldn't tap those things from the social space into the business space. That's not what is being advocated for here. Alright, so that's laws and regulations. Alright, now what are the responsibilities of managers and responsibilities of auditors? It is the responsibility of management to ensure that an entity complies with the relevant laws and regulations. It is not the responsibility of the auditor to either prevent or detect non-compliance. Alright. Now, in a December 2011 paper, question number 1C for 4 marks, asked candidates to explain the responsibilities of management and auditors of Chuck Industries Co. in relation to compliance with laws and regulations under ISA 250, consideration of laws and regulations in an audit of financial statements. The question itself was linked to a brief scenario where Chuck Industries Co. had received a visit from the tax authority, who had discovered incorrect levels of tax had been deducted from the payroll as tax rates had not been updated in the previous year, and the finance director was questioning the audit firm as to why they had not identified this non-compliance with tax legislation. Excuse me. So, in this case, the finance director was actually passing the buck to the auditors as an escape route. So, to secure a pass in this part of the question, candidates would have to understand that it is the role of the management of Chuck Industries Co. to ensure the operations of the entity are conducted in accordance with the laws and regulations. This applies to tax legislation also. Appreciate that an auditor is not responsible for prevention of non-compliance with laws and regulations and is not expected to detect instances of non-compliance. Acknowledge in the answer that it is the auditor's responsibility to obtain reasonable assurance that the financial statements are free from material misstatements. To that end, the auditor will take into account the legal and regulatory framework within which the entity operates. So, his responsibility will be just to obtain reasonable assurance that the financial statements are free from material misstatement. To that end, the auditor will also take into account the legal and regulatory framework within which the entity operates. Make reference to the auditor's responsibility to consider the laws and regulations that have both a direct and indirect effect on the determination of material amounts and disclosures in the financial statements. So, once again, the focus of the auditor is on financial statements. That's the focus of the auditor. So, whatever it is with the rules and regulations, whatever with fraud, there should be some indirect or direct effect on financial statements. If everything does not actually link to the financial statement, then the auditor cannot be blamed there. Alright? Now, direct and indirect laws and regulations. There are many laws and regulations that a reporting entity may have to comply with in order to continue in business. For example, many entities will have to comply with strict health and safety regulations. A food manufacturer may have strict food hygiene legislation to comply with, and an accounting firm will have a code of ethics to follow from its professional board. Such laws and regulations will have both direct effect on the financial statements and indirect effect. For those laws and regulations that have a direct effect on the financial statement, the auditor will be concerned about gathering sufficient appropriate audit evidence that the entity has complied with such laws and regulations. For example, when auditing the payroll, the auditor will be concerned with gathering sufficient and appropriate audit evidence to ensure that tax legislation has been correctly applied by the entity, because if it has not, as in question 1C in the December 2011 FA exam, there is risk that the entity could be fined for non-compliance, and the fines could be material either in isolation or when acted with other misstatements. In addition, amounts with the financial statements may also be misstated as a result of the non-compliance with laws and regulations. For those laws and regulations that have an indirect effect on the financial statement, the auditor will undertake procedures with the objective of identifying non-compliance with laws and regulations. ISA 250 gives examples of paragraph 6b of compliance with the terms of an operating license, compliance with regulatory solvency requirements, or compliance with environmental regulations. So those issues might not have a direct link to the figures which have been reported in the financial statement, but they could also affect the operational capabilities of the entity. Because, for example, if you violate terms of your operating license, then you might end up being closed down. Okay, so even if the breach could not have a direct bearing on the reported figures in the financial statements, but there could be some consequences attached to those. So those are the indirect consequences of the breach of regulations. All right. When designing procedures to help to identify non-compliance with laws and regulations, ISA 315 identify and assessing the risks of material misstatement through understanding the entity and its environment requires an auditor to obtain a general understanding of the applicable legal and regulatory framework and how the entity complies with that framework. Identifying non-compliance laws and regulations can be tricky for auditors, particularly when a fraud or money laundering is concerned. Alright, see later in this video. It is for this reason that the auditor must maintain a degree of professional skepticism. We talked about this. Professional skepticism, and remain alert to the possibility that other audit procedures applied may bring instances of non-compliance or suspected non-compliance with laws and regulations to the orders obtained, and such procedures could include reading minutes of the board. Okay, of course, we have always, and I have always reiterated this, that don't just tell the examiner, read board minutes. you need also to explain, but we'll talk about those ones during our revision phase. Ensuring inquiring of management or legal advice concerning litigation or claims brought against the entity, and undertaking substantive tests on classes of transactions, account balances, and disclosures. Alright, so it's how you may actually try to mitigate the issues of non-compliance or to respond to such situations. Excuse me. So, reporting identified or suspected non-compliance with laws and regulations. When the auditor discovers non-compliance with laws and regulations, the auditor must notify those charged with governance. However, care must be taken by the auditor, because if the auditor suspects that those charged with governance are involved, the auditor must then communicate with the next highest level of authority, which may include the audit committee. If a higher level of authority does not exist, the auditor will then consider to seek legal advice. The auditor must also consider whether the non-compliance is a material effect of the financial statements, and in turn the impact the non-compliance will have on the report. If the auditor identifies or suspects non-compliance, the auditor will need to consider whether law, regulation, and ethical requirements either require the auditor to report to an appropriate authority outside the entity or establish responsibilities under which this may be appropriate. You actually need to know. It's not an issue of just guessing things about or to use emotions. You just have to know that you are well guided and you are acting in accordance with professional remits. Alright. There may be occasions where the auditor's duty of confidentiality may be overridden by law or statute. This can be the case when the auditor discovers non-compliance with legislation such as drug trafficking or money laundering. Here, there are actually specific legislations addressing those issues, and you as the auditor, you also need to act accordingly or being well guided. Now, this is the last segment of this lecture which we have to touch on. Remember, ladies and gentlemen, money laundering is actually on the rise. Alright, is actually going on the higher side, because everyone, every person, every thief, every armed robber wants to live a smart, blame-free life. So they need to wash their dirty linen. They strive to ensure they also have a clean profile. So you can see here there is this washing machine there that is washing money. Okay, there's money that has been washed there and it is now being dried on the line. Okay, just to make sure that the dirty it emanated from. Okay, the dirt from which it came is actually blown away. So that's money laundering. We are talking about cleaning dirty money to become smart, to become clean, to become acceptable to the society or to our business dealing. Okay, so in the process of washing, a thief might actually be prepared to ensure that some of the money is destroyed, but is left with something. Even if the taxman comes and say, hey man, give us 40% of that money, he is ready to give away because he just wants to be clean by the end of the day. But you as the auditor, you just have to question everything, okay? Because he shouldn't have that money in the first place. So even if it is 10%, we do not want him to go away with that 10%. Okay, so if you look closely, these pictures illustrate the idea of money laundering in general. Now, money laundering, what is it? It is the process by which criminals attempt to conceal the true origin and ownership of the proceeds of their criminal activity, allowing them to maintain control over the proceeds and ultimately providing a legitimate cover for their sources of income. So in this case, criminals will be trying to hide. The idea is trying to hide the true origin. Hiding the true origin of the criminal activities attached to the money. Alright, so auditors need to be particularly careful when money laundering issues are concerned, especially for a business that is predominantly cash-based, because the scope of money, the scope for money laundering in such cases is wide. So when your client is somebody who's dealing with cash transactions all the time, who is a cash-based business, then the risk of money laundering there is very high. For example, you are auditing a casino. In a casino, most of the transactions, or in a betting shop, most of the transactions are cash-based. So in those businesses, money laundering is actually very high. The risk of money laundering is very high. There are 3 stages in which money laundering is involved. There is what is called the placement stage, which is the introduction or placement of illegal funds into a financial system. Then there is layering, which is where the money is passed through a large number of transactions. This is done so that it makes it difficult to trace the money to its original source. Then there is integration, where after doing everything, the guy then starts to withdraw the money. You can see this guy here is now trying to withdraw the money after it had been entering so many layers there. Okay, then he has to withdraw it out after being laundered. Alright, money laundering offenses. The offenses now, there is what is called concealing criminal property. Okay, knowing that you've been involved or in money laundering, or somebody has been involved, but he is your peer, is your friend, then it gives you the properties which they have stolen. Then you keep those properties safe. You are also part of this offense called concealing criminal property. Then acquiring, using, or possessing criminal property, you are also going to be named. Becoming involved in arrangement which is known or suspected of facilitating money laundering, then you are also going to be named. There are many countries in which money laundering is a criminal offense, and where an accountant or an auditor discovers a situation which may give rise to money laundering, the accountant or auditor must report such suspicion to a money laundering officer. Excuse me. A money laundering reporting officer whose responsibility is to report such suspicion to an enforcement agency. In the UK, this enforcement agent is the National Crime Agency. It is an offence to fail to report suspicions of money laundering to NCA or the MLRO as soon as practicable. And it is also an offence if the MLRO fails to pass on a report to the NCA, alright, the National Crime Agency. That is, if you are in the UK. Where the entity is actively involved in money laundering, the signs are likely to be similar to those where there is risk of fraud, and can include complex corporate structure where complexity does not seem to be warranted. So you can see that there is this small shop with a small company, that has got only three branches nationwide. Okay, but they have got a board which has got about 15 directors. The 15 directors, there is a CEO. Okay, there is also a deputy CEO. After a deputy CEO, there is this one. Then you've got this one. The hierarchy goes this one. There are a lot of guys to be reported to. The hierarchy is so complex. They also have got other guys here. You know, such type of a setup is actually going to signal something that something might actually be fishy here. Then transactions not in the ordinary course of business, right? They are dealing actually in a tailoring business. That's what they purport to be supplying. but during the course of your audit, you see that there was actually money coming from Vietnam, huge sums of money, and you try to ask them, they tell you that it was from a customer. What type of a customer, or which you were selling such type of of merchandise? Can you sell school uniforms to somebody in Dubai from Zimbabwe? Or that's something that actually might actually raise eyebrows. Many large cash transactions were not expected. You see that there is a particular large sums of money or cash transactions being crowding at a particular portion or during some particular weeks over the year. And you just have to actually ask what was going on. Transactions where there is a lack of information or explanations, or where explanations are unsatisfactory, just have to suspect, or maybe without being given any explanation, you are just being thrown tantrums by the directors. Then you can actually see that something could be wrong. Transactions with little commercial logic are taking place in the normal course of business. All right. When the transaction is actually not warranting some commercial logic, then you also have to be very skeptical of those. Alright, now question 3B in the March-June 2016 P7 paper. Of course, we are doing the audit assurance and not the advanced audit assurance, but this could also be helpful to us. Okay, give candidates a scenario where they were placed in the position of audit manager. The audit senior had noted as part of their review of the cash book a receipt of 350,000 for which the source was unclear, followed by a transfer of the same amount to a bank account held in another country. When questioned, the financial controller had referred the audit senior to the business owner. Documentary evidence had been requested but had not been received. This particular question did not make reference to the term money laundering in the scenario or in the question requirement. The question required the candidates to evaluate the implications for the completion of the audit, recommending any further actions which should be taken by the firm. The fact that no mention of money laundering was made either in the scenario or in the question requirement is reflective of the fact that in real life, those committing money laundering do not openly admit to committing such offences. Money laundering is therefore very similar, if not identical in many ways, to fraud, and therefore auditors should set aside any beliefs concerning the integrity and honesty of the audit client and keep a skeptical mindset when such issues are concerned. So you just have to be very watchful. Because managers change, people change. Okay, they were good yesterday, but doesn't mean that they are still good today. You just have to maintain some attitude of detachment. So you just have to be professionally skeptical. Now, tipping off. The term tipping off means that the MLRO discloses something that will prejudice an investigation. So when you tip off, you are actually getting on the way of the investigation. You end up prejudicing whatever that has been gathered. So tipping off is actually not allowed. It is an offense to make the perpetrators of money laundering aware that the auditor has suspicion or knowledge regarding their money laundering activities, or that these suspicions or knowledge has been reported. It is unnecessary for the auditor to gain all the facts or to ascertain without doubt that an offense has occurred. So, what you actually suspect that there could be some money laundering happening, you need not to say to find all the facts, because through the process of gathering all the facts, that's when you end up tipping off people. So, once you get some suspicion, you then have to consider reporting the issue. The auditor only needs to satisfy themselves that their suspicions are reasonable and obtain sufficient evidence to show the allegations are made a good faith. Alright. Now, the examiners always reiterated that candidates adopting AA or AAA should gain a sound understanding of laws and regulations, not only in the context of the syllabus and study guide, but also in the context of real-life situations to allow for greater applications of knowledge. Now, I think we have actually done justice to this particular topic, but I would also want you to go deeper into your data gathering exercise to actually dig deeper on this fraud era and laws and regulations topic, so that you have to be comfortable with this part of the syllabus, because it is usually common in the exam. Alright, and I want you also to attempt the questions, the assignments. Alright, do the assignments. Please do the assignments, because they assist you in understanding better, and that's part of continuous assessment, so that you're not going to be taken away on exam day. The more you practice, the better, the more you improve. So until next time, may the good Lord bless you. Thank you. All right.